Well, folks, it should have been a really, really good day in the public count here today. A lot of positions very, very green, but one position exceptionally red, and that is my number one stock ever. Elf on a Shelf down about 15% today, down $28,000 plus on this stock. It absolutely just pulled down the entire portfolio. Didn't matter that Meta, Tesla, all these other ones were green because that one was so far red here today, okay? So at the top of this video, we're going to talk about Elf. What's going on with this stock, okay? How worried am I about Elf stock moving forward? And I am actually a little worried, and I'll explain why I'm a little concerned in regards to stock in this video here today, right? Obviously, it's been a tremendous performer. It's definitely my best percentage gainer ever in the public count. But yeah, we have some changes going on there, so we got to speak about that. Palantir, speaking about changes, this stock just closed over $30 for the first time in 3.5 years. 3.5 years it's been since this stock closed over 30, and it just did it. So we're going to talk about, is this about it for the move? Do we have more upside in regards to stock in the short term? Or obviously Palantir is a great company for the long term. We all know that. But I'm going to focus a little bit more on the short term here, as in like the next 3 to 6 months. Do we have more upside ahead? We'll speak about that in this video, okay? Meta stock. Could this stock reach 700 plus this year? I'm going to kind of lay out the case why this stock's going to likely hit 700 plus this year, okay? PayPal, finally getting some respect for the first time in 3 years. What do I mean by that? I'm going to show you in this video here today exactly what I mean by that. Hope you guys enjoy this video. As always, appreciate y'all joining me here. If you're looking to apply to join my private group, my private wealth group, my private stock group, that will be the pinned comment down there. Get access to 1000xstocks.com. Take your game up to a much higher level than where you're at right now. And then also, I appreciate everybody being subscribed here. We just hit a new all-time high in the history of the channel in terms of subscribers. A new 1,900 people have joined us recently, so appreciate each and every one of you, whether you're an OG or whether you're somewhat new here. And thank you, everybody that smashes that thumbs up button, video in and video out. Appreciate you guys, okay? Alrighty, let's talk about it. Elf on a Shelf. Uh-oh. So, Elf on a Shelf actually didn't have a great income statement for once. No, it was a C-grade income statement. Net sales, so basically revenue, was up to $324 million from $216. It's very good. Cost of sales was only up $30 million year over year, which, you know, ideally cost of sales, you wouldn't want to see it up, but let's be honest, you're selling physical products in the world, right? And if your revenue is up $100 million plus, you got to assume your cost of sales is going to be up at least 30 mil, right? And so naturally their cost of sales was up, but gross profit exploded to the company at 231 mil from 152 mil. So as of right now, if the income statement ended there, we look great, absolutely great. But then we start running into problems right here. Look at selling general administrative expenses. It about 2x on a year-over-year basis. It went to 180 million from 91 million. No bueno. No bueno. Okay. Here's a problem. SG&A was about 100. We can call it roughly 100% up year over year. Revenue was around 50% up year over year. So that's not good, right? Ideally, if revenue's up 50%, you'd want SG&A to be up 50% or less than 50%, right? Now, operating income dropped for the company year over year to $50 million from $60 million. Net income for the company dropped from $52 million, almost $53 million, to $47 million. Okay, so clearly Elf is spending aggressively. Now, the reason they're spending so much is because they believe there's such a huge market opportunity over the long term that they would rather spend aggressively up front, expand this business, push things to the maximum level right now, grab as much market share as possible, and worry about profitability 2025 and beyond. It is a similar philosophy that a lot of tech companies use. So a lot of tech companies, essentially, they'll spend like crazy for years and years and years, grab market share, run up the numbers in terms of revenue, and then when they become a little bit more of a mature business, meaning their revenue kind of gets to like a 20% clip growth and below, that's when they focus on that profitability. And you see their earnings per share skyrocket, right? You see their net income skyrocket in that sort of situation. And so Elf is playing a similar game, a very similar game that these tech companies ultimately play, right? Now, if we look at their outlook, they also upped their outlook numbers across the board. They're expecting revenue to be ahead of where they thought it was going to be, adjusted EBITDA, adjusted net income, diluted EPS, but these raises aren't like crazy high raises. They're up, but it's not like to the moon type up, right? And so the moral of the story is good to see them bring up all their numbers, but I think a lot of people, including myself, I talked to you guys about this, I think we had all expected this, right? They usually come in sandbag numbers, then they come in and up those numbers throughout the year. So we would have liked to see a little bit higher numbers there, okay? Now, let's pick apart this revenue growth, which is a very difficult thing to do when a company's grown revenue 50%, right? It reminds me similar of way back in the day when I was in like high school. My brother, and when I was in college, my brother and I, we used to argue back and forth who was a better quarterback. My brother would argue the case that Peyton Manning was a better quarterback than Tom Brady, and I would make the argument that Tom Brady was the better quarterback than Peyton Manning, right? And we'd make these points back and forth. Back in the day, it was always very entertaining, right? But both those guys are so great that you're like picking apart like little things in regards to like how great somebody is. And so in regards to Elf is such a great stock. It is so hard to pick this stock apart because it's such a freaking good company, right? It's top tier. By the way, if you have no clue about NFL, you don't know what I was just talking about in regards to Brady and Manning. If you watch NFL, you know what I'm talking about, okay? But let's pick this apart. So if we look at the last couple years, when we went from the end of a fiscal year into the next fiscal year, there was a major ramp up in revenue. Okay, so we can see that right here from fiscal year 22 to 23. From fiscal year 23 to 24, we also see that with Elf. See that big revenue ramp there? But look at recently. On a sequential basis, it's around flattish, right? So this was like revenue growth was taking off to the moon, right? And this is like, oh, revenue starting to chill out a bit, right? So it's something you kind of look at and you kind of say, ooh, the revenue's not trending the way it was trending. That's the way somebody might look at something like that if we're trying to pick these numbers apart, right? The other thing you might also say is we had revenue of, look at this, 78%, 76%, 76%, 85%, 71%, and then down to 50%, right? So you had 1, 2, 3, 4, 5. You had 5 straight quarters where the company was growing revenues at 70% or above, and we've clearly broken that trend now. We're down to 50%, right? Which is still an amazing number. But people say, okay, 70 to 50, how fast are we going to go from 50 to 30? And then how fast are we going to go from 30 to 10? So that's what people start running to in this sort of situation, right? Now, in terms of consumption, this is really good. If you're thinking about the long-term Elf, this is something you want to see. Consumption, so this isn't just selling into a store. This is like people actually buying product, right? Consumption was up 26%, Elf in the color category versus -1% for the category, right? Clearly, Elf is gaining market share. If we look at dollar share growth, they're up about 260 basis points versus Maybelline, L'Oreal, CoverGirl, Revlon, these sorts of guys. Those big companies are all down, right? All the way down to Chinatown. Elf Cosmetics dollar share, look at this. This is in a matter of 3 years. It went from about 5.7% up to 12.3%. Whew, they're taking market share big. Look at this here. The Elf Cosmetics dollar share at Target. Check this out. In the past year and a half, they went from about 12.7% to 21.4%. That means, essentially, Elf is going to be able to command more and more shelf space in these stores, more and more items in. Because if you're a retailer, if you're a Walmart, Target, whoever, right, and you see a company like Elf is selling great, you're going to say, let's bring in more of the product. Let's bring more of the product. And when you have let's call it, when you have a situation where there's other brands that aren't selling that well, you kick them out, right? You only have so much shelf space in your store. You need to be doing as many dollars as possible. So you kick the bad stuff out, right? I came from the retail world. I used to work for Walgreens back in the day, Quick Trip. If you were a product that didn't sell, you got kicked to the door. And you know what got brought in more? Good selling products. For instance, like Monster. Back when I worked at Quick Trip, I remember it was a decent Monster section and that product sold so well, it got bigger and it got bigger and it got bigger over time, right? That's what happens, right? Same thing in cosmetics. Now, this is a huge opportunity for Elf. Skincare. They grew consumption by 45%. Oh my gosh, right? Versus the skincare category of 1.4% growth, right? That's about 32x. So skincare is taken off for the company. Look at their skincare dollar share. They have so much room for growth in regards to skincare. It's not even funny. And you're going to see this company grow massively over this next 3 to 5 years in skincare, which is a huge opportunity for them. They also bought this brand Notorium. They bought this brand out about a year ago or so, and this brand has exponential growth ahead for the company overall. Speaking about exponential growth, international. It's booming. 91% international sales growth for this company. I mean, who's putting up these sorts of numbers? 91% international sales growth? And I'm not just talking about who's putting up these type of numbers in regards to a cosmetic company. I'm talking about who's putting up these type of numbers in the whole stock market. I mean, who are you thinking of? NVIDIA? Like who else is really putting up these sorts of numbers, right? Now, the beautiful thing with e.l.f., right, is their products are very affordable. And this is one of my theses I've always had on this company is there's a type of company that doesn't matter inflation, recessions, good consumer environment, bad consumer environment, they can put up numbers because their product is so affordable compared to peer products, right? And their quality is very good for their products. And the only way I know that is because I've watched a million YouTube videos and different folks' opinion on e.l.f. products over the last 5, 6, 7 years. And they always have positive things to say. I could also speak to my wife about that as well, right? And ask almost any female, they'll tell you the e.l.f. products are very high quality for how affordable they are. Now, look at the unit volume growth for this company. 25% growth versus negative 8% for Maybelline, negative 7% for L'Oreal, negative 8% for CoverGirl, and negative 15% for Revlon. e.l.f. on a shelf is taking market share. Now, look at a 5-year chart of e.l.f. on a shelf versus Estee Lauder. Now, I just started buying Estee Lauder stock in the past week or so, right? And that's a stock I want to buy a lot of shares of over this next, I would say, 6 months or so, right? Now, you got to understand what has transpired over the past 5 years and what's likely to transpire over the next 5 years, okay? So if we think about the last 5 years, we think about some very freak situations happen that really hurt the consumer massively, right? Think about this for a moment. We had a once-in-a-100-year health event where the global economy got shut down. That was Rona, right? Additionally, in the last 5 years, we had the highest inflation in the past 40 or 50 years. And if inflation numbers were run the same way they were run back in the 1970s into the early 80s, there's a very high probability that the inflation numbers you would have seen were actually worse than back then. Worse, okay? So in that sort of environment, e.l.f. is the biggest beneficiary because people will continue to do skincare, they'll continue to wear cosmetics, but they will pull back on where they're spending that money. Estee Lauder, for instance, Estee Lauder's high end, right? A lot of their products are $50, $100, right? Even more than $100. Whereas e.l.f. products are like $5, $10, $15, right? And so Estee Lauder, look at that, over the past 5 years, the stock's lost half its value, right? Because the consumer just seems like it's gotten worse and worse over the last 5 years. e.l.f. on a shelf, however, 800% gain. It's a big divergence there, right? And I'll put it to you like this. From January 2010 to January 2020, that 10-year span there, right? It felt like the feeling overall, and you could also back this up with numbers, right? But there was a feeling of the consumer was getting better, and it felt like everybody was doing better and better and better over that 10-year span, right? It didn't matter if you were somebody that made $40,000 a year, somebody that made $60,000 a year, $100,000. It didn't matter what income bracket we were talking about. For that 10-year span, it felt like everybody was doing better, right? And that benefited, honestly, it benefited all companies. It didn't matter if you were an Estee Lauder or an e.l.f. or an Apple or a Tesla. It didn't matter who you were. Everybody really benefited from that because it felt like everybody was getting better, right? But I will say this, in the past, we can call it since January, we can say January 2020 through August 2024, right? The feeling is some are doing bad, right? Some people are doing bad. Some people are clinging on, and then some people are doing good, right? And that really hurts companies like an Estee Lauder, right? For instance, it's not ideal to feel like there's a lot of people doing bad, some are clinging on, some are doing good, versus a feeling of like it felt like everybody was doing better for that time. And honestly, we can see it in these different companies. It's not just looking at Estee Lauder versus an e.l.f. over the past, 5 years. You can also see it in looking like something like Ferrari. Look at Ferrari's revenue on a trailing basis. It just goes up and up and up and up. Why? Well, who are the people that actually are doing better? It's the top 10% of income earners, the top 10% of wealthy, right? If you own real estate over the past 5 years, it's never been better for you. If you own stocks in the past 5 years, it's never been better for you. If you have substantial amounts of money behind you that you can have in a savings account or treasuries yielding you 4 to 5%, it's never been better for you. So the top 10% of income earners, the top 10% of wealthy are doing better than ever. And so guess what? Ferrari sales are doing better than ever. But then we break it down to something like Tesla, right? Look at Tesla. Tesla's counting on the masses. Tesla's trying to sell millions of vehicles a year now, right? Ferrari's trying to sell a very select amount of vehicles a year, right? I think Ferrari sells, 10,000 cars a year? Tesla's trying to sell millions. They want to sell 2 million, 3 million, 5 million, 10 million cars a year, right? That's where they're trying to go to. And look at how much this company struggled in terms of their revenue over the past, we can call it 5-6 quarters. And that's because of this feeling about unless you're at the very, very top, it hasn't been a good feeling. It's more like people are clinging on or they're doing bad, right? And keep in mind, these numbers for Tesla would be far worse if they didn't have the energy side of the business. The energy side of the business is actually kind of bailed out their overall revenue numbers because the energy side of the business has been pretty substantial growth here recently, okay? So, no, I'm worried about Alf a little bit, okay? And here's why I'm worried. I'm showing you Celsius stock in front of you right now. Why am I showing you Celsius stock? Well, Celsius stock's down 60+% in the past, we can call it 11 or 12 weeks, right? The stock's gotten absolutely obliterated. It hasn't shown a bottom anywhere in sight. It's been bad, right? And the reason I'm showing you that stock is, so the reason Celsius stock has crashed this bad is because the company had a very high valuation on it. If we look at 1000xstocks.com here, right? Celsius had a very rich valuation on it, traded a very high forward P, a very high 2-year out forward P. And the reason it commanded those sorts of multiples is because the growth rates were outstanding for this company, right? They're growing revenues off the charts. But now Celsius's revenue growth has come to a standstill if you compare it to how the company was growing. Now they're growing revenues in the 20s. They were growing revenues at 70% clips, right? If not above that. And so when you go from that down to that, people are like, what? What happens if this happens with Elf, right? Elf was growing in the 70% revenue, right? What happens if they go down to a 20%? 20% would be amazing, right? 23%, I think Celsius's recent quarter, they grew revenue 23% if I recall, right? That would still be amazing for Elf, but it's a long way from 70%, right? And so when you look at Elf and you look at kind of the forward P of 50 or so, right? 2-year out forward P a little under 40, that's something you look at and people are going to look at that and say, ooh, rich valuation if your growth rates are slowing substantially. Now, for now, Elf can kind of put a floor under this stock here, right? Because they're still growing 50% revenue. But if this growth was to go down to, let's say, a 35% clip here, that's when you talk about you could get a leg lower in this one, right? And, you could have another kind of move down. And so this is just kind of a little food for thought in regards to Elf. So the way I would put it in regards to Elf is the next 5 months are up in the air in regards to Elf. I mean, I wouldn't be surprised if Elf goes back up to $180. I wouldn't be surprised if it goes down to $140 or $120 over the next 5 months. If we went really risk off in regards to the market, plus there are worries about Elf's growth, could the stock go back down to $100? It could, which is a long way when you're at 160, right? But over the next 5 years, I'm feeling great in regards to Elf stock. They're doing everything you want to see them do. They're growing their business. They're taking massive amounts of market share. And my view is, as far as SG&A goes, they will rein that in, likely starting next year and then moving in future years. So how they'll rein that in essentially is, I believe SG&A will start to stagnate in 2025. And there is a potential they could even cut SG&A, but I think it's going to be a little bit more of a stagnation where you're not going to see the numbers move up very much, but the revenue is going to keep moving up. Right? Even if the growth goes from 70% down to 20%, still a huge number there, right? And when your SG&A starts to stagnate, but your revenue is still going up at a very healthy clip of double digits, guess what happens to your bottom line? You see an earnings per share explosion, which is exactly what I think you were going to see in Elf in 2025 and moving into 2026, 2027. But it's going to be awkward for a little while. And the reason it's going to be awkward is Elf has attracted a growth shareholder base, right? And so when we move the stock from being, it's about the 50%, 70% insane growth rates, right? And we move it down to more of, we can call it 15 to 25% type growth rates in terms of revenue, right? And it's all of a sudden it's all about the earnings per share growth of 40, 50% year over year. It's going to be an awkward stage because then you're going to go from more growth investors want the stock to more value investors want the stock, right? And there's going to be a whole kind of switch out there. So Elf's kind of in awkward territory for the short term, but they're in great territory for long term. It's clear as day. Their numbers are phenomenal. Now, when it comes to Palantir, first close for the stock, over $30 in 3.5 years, right? That's incredible. So is this about it in regards to Palantir when it comes to their stock price? Here's what I'll say. So we obviously saw a couple, I think it was yesterday, the Palantir Microsoft deal got announced, right? And Webbush comes out today. They say this is a launching pad for Palantir. This week's announcement that Palantir has signed a deal with Microsoft to provide artificial intelligence services for the defense and intelligence communities is potentially, quote, game-changing and likely to be a launching pad for Palantir's AIP, Webbush Security said. With this marquee deal solidified with Microsoft leveraging Palantir for AI and LLM, large language model, capabilities to the U.S. government, the company can now increase the pace of AI implementation while Palantir continues to accelerate AIP adoption with the federal sector, said Dan Ives in a note to investors. Quote, we believe this will be a launching pad for Palantir AIP story to hit the DoD, the Department of Defense, and broader Beltway ecosystem over the next 12 to 18 months, end quote, right? Ives put a $38 price target on the stock. So, obviously, this is very exciting for Palantir. Here's the deal with Palantir, okay? Palantir is officially split from short-term valuations, okay? It no longer matters in the short term what Palantir's forward P is or 2-year forward P is or trailing 12 month or the price to sales ratio. Honestly, all that's irrelevant in the short term, right? All that will matter over the next 10 years, but in the short term, that doesn't matter at all. No one cares about that right now, okay? This is a whole different story now. And so if we're talking about Palantir, where we go from here, it really depends on 4 factors, right? What happens if Wall Street keeps coming out and upgrading the stock, coming out, bringing up their price targets in regards to this? A lot of other big investment banks start following Palantir that aren't right now, start putting out notes. It's very possible Palantir could become a Wall Street hype stock. If you look over the past few years, Palantir's talked about a lot in the retail community. It's kind of like a retail hype stock, right? It's not a Wall Street hype stock, but we might be on the verge of Palantir becoming a Wall Street hype stock, where everybody on Wall Street starts talking about it and wants to own this stock, okay? Now, additionally, S&P 500 inclusion, that's likely coming in the next, I would say few months here. It's not a guarantee, but I would say it's likely coming, given how big Palantir's market cap now, which I believe is well over $60 billion, given the company's profitability, given the company how much it's talked about. I believe it's getting in the S&P 500 sooner rather than later. Whenever that happens, it's huge, right? Because then you're going to have so much forced buying come in this stock once they actually get in the S&P 500, right? Growth rates. What happens if growth rates continue to accelerate for this company? What happens if we get back to that 30% revenue growth? The company did not guide for that, but what happens if it happens, right? 27% this last quarter, who's to say they can't do a 30% number coming up here? And that would be shocking. No one's really expecting that, right? And then the fourth thing is, this is kind of a perfect chase stock for a lot of these big hedge funds, a lot of these big investors. The reason being is, I believe a lot of them are underperforming the market pretty significantly this year because a lot of people weren't expecting the market to go this risk on. The S&P 500 is having a great year. The NASDAQ's having a phenomenal year. And if you're a fund manager, you're likely underperforming. So which means you're going to have to chase into year end. And a lot of times the stocks you look to chase into year end are the stocks that are exciting, that have been performing tremendous over the past couple of years. Who would fit that criteria? Palantir, right? And so if you're looking to chase and try to get that alpha on the market, you might be looking at something like Palantir. And so overall, the sky's the limit in regards to Palantir in the short term. Obviously, like I said, over the long term, what actually happens to the earnings per share and what do we feel like is a fair forward P for the stock is what will matter. But in the short term, none of that matters in the short term, okay? And so as a long-term investor, I'm just along for this ride. Take it wherever you want to take it. They might take it to 50. We'll see. Meta. Could Meta hit $700 plus this year, right? This is a number I've thrown out there that I think is a potential, right? Stock's at about 514. And let me say there's a pretty decent probability the stock could hit 700 plus this year, which is, we got 5 months left here roughly in the year, right? So there's a few reasons. First one is the company's been growing very, very nicely, right? 20% plus on revenues. Their earnings per share has been taking off like a rocket ship. And I looked at next year's numbers here. If Meta comes in and beats revenue estimates and earnings per share estimates again next quarter, which they probably are going to do that, by the way, I think analysts are going to start bringing up their projections for 2025, right? And so there's room for, in my opinion, for upside expansion in revenue estimates and earnings per share estimates for 25, which will then cause a price target kind of cycle upgrade for Meta, as well as also just positive commentary from Wall Street as well as far as what 2025 holds for Meta, right? And that's going to be very substantial, and that will likely move the stock pretty big to the upside. Additionally, I went with some super conservative numbers for Meta. I went with 10% revenue growth for the next few years and just ran some numbers here on 1000X with our new valuation calculator rate, where you can type in what you're expecting revenue growth, net income growth, what do you think a fair PE range would be for that stock, right? And once again, if you want access to that, it would be pinned comment down there. And you get access to this as well as my private stock group, my private wealth group, right? But look at this. I ran a 10% revenue growth. Keep in mind, Meta's been growing way over 20% clips. So a 10% would be a massive deceleration, right, for Meta. But if I ran 10% for the next few years, and I ran a net income growth of 15%, which is horrible compared to how the company's been growing, the company's been growing earnings per share way faster than a 15% clip. Like, this is horrible. Even with those trash numbers, and with a valuation of 25 to 35, which is very, very fair for a stock like Meta, I wouldn't call, 25 is actually undervalued. And I wouldn't call 35 overvalued either in regards to Meta, considering if you can grow double digits top line, bottom line, right? The stock right now should be somewhere between about $530 and about $745 right now, right? Next year, and this is off these super conservative numbers I have over the next few years, next year the stock should be somewhere between about 600 in my opinion and about 850. In 2026, the stock should be somewhere between about 700 and about $1,000. If we look at 2027, the stock should be somewhere between about 800 and about 1100, and then 2028 somewhere between about $900 and about $1,300. And that's off those super conservative numbers, right? I mean, there's a pretty high probability they're going to be ahead of those revenue estimates over the coming years and ahead of those net income numbers. So my opinion is, I think Meta likely, outside of, if we have some sort of big, massive market move down in NASDAQ or something like that, that could change the trajectory here. But I think as long as this market stays decently risk on, not even the most risk on, like just kind of floats a little higher for the remainder of the year, I think there's actually a pretty decent probability in Meta we'll see a 700 number on that stock this year, right? So, at the end of the day, when it comes to a stock like Meta, this is a main course for your portfolio, right? Certain stocks like Meta, Amazon, these sorts of companies, they're the steak, they're the chicken, they're the shrimp of your entree, right? And then everything else goes around that. The rest of it's side dishes. And so I feel very comfortable. There's a $678,000 gain we're sitting on. Don't be surprised if this is an $800,000, $900,000 gain very shortly here. So we'll see what happens. But yeah, Meta's looking really, really good. Now that takes me to speak about PayPal. So we have a big change in regards to PayPal stock. And cheers to all PayPal shareholders, because this is the first time we've seen a positive change like this in 3 years. So, thank goodness I haven't owned the stock for 3 years. Oh my gosh. And I actually just turned positive on my PayPal shares here recently, which I'm very excited about. But we get a major change in regards to PayPal. So, this is the past 2 weeks for PayPal versus two things specifically. The Russell 2000 and KRE, which is the regional bank index. And the reason I put those is PayPal stock for the past many years has many times moved in relation to the Russell and moved in relation to KRE. And think of it like this. If people are feeling a little more risk on, they like to pile into something like the Russell, they like to pile into something like regional banks, KRE. If people are feeling more bearish, they don't want to own the Russell. They don't want to own small cap stocks because they're feeling bearish. So why would they want to own more volatile small companies, right? They wouldn't want it, right? That's more like small caps are more the play if you're feeling risk on. Regional banks, same exact thing. If you're feeling not super confident about the state of the economy and those sorts of things, if you're going to own something in banking, you're going to go to the big dogs. You're going to go to JP Morgan, right? And that's who you want to play. If you're feeling more risk on, you're feeling good about the economy, right? You're going to play something like KRE. So basically over the past 2 weeks, people have gone actually risk off. Even though the market's been decent for some of the top stocks, right? People have gone risk off the last 2 weeks. Look at the Russell's down 7% over that time. The KRE's down over 9% over that time. And look at PayPal. Massive divergence. Not a small divergence, right? If PayPal was down like 5%, I'd say, okay, it's kind of doing what it's been doing in regards to Russell and KRE. No, PayPal's up double-digit percent in the past 2 weeks. It's up 10%. So we have a major divergence going on here. What does that tell me? That tells me I believe Wall Street is starting, keyword is starting to understand the PayPal story. When you looked at those latest numbers, when you walked away from that latest conference call, it is near impossible not to walk away feeling pretty darn good about PayPal. You might walk away from that and not feel the most bullish of bulls out there in regards to PayPal, but you got to feel pretty darn good. And I think Wall Street's slowly starting to recognize PayPal is a special story in this market, which I think there was some sort of belief that like their revenue was going to stop and their net income was going to stop, and we're not seeing that at all. We're seeing the revenue climb higher. We're seeing that net income climb higher, even with everything we got going on with the consumer, with competition, all that stuff. And it's looking pretty darn good. And so I think Wall Street's starting to become more of a believer, which this tells me when the market does go more risk on. So when we do see KRE start to go up substantially again, when we start to see the Russell perform very well again, which is, who knows what could happen over the next few weeks, that might take months for that to play out. It might take a year, we don't know. But when that does happen, I think you're going to see PayPal explode way higher to the upside than the Russell will, the KRE, and those sorts of things. The fact that it's already starting to outperform so significantly in a downtrend for those over the past 2 weeks shows me that when those do reverse, whenever that is, you're going to see PayPal be basically like a call option on the Russell. So if all of a sudden the Russell goes up 10%, I wouldn't be surprised if PayPal over that time goes up 30% or 40% or something like that. Same thing with the KRE. If the KRE goes up 10%, I wouldn't be surprised if all of a sudden PayPal's up 30 or 40% in that amount of time. Okay, so this is very exciting. I will say very exciting for PayPal because the first time it's actually gotten some love and respect. And keep in mind, we're still very early in terms of people understanding Alex Christ, understand the business model of PayPal, what they have going on here, and what this means for their numbers over the next several quarters and the next several years. And as more and more people understand and then look at that valuation, it's going to be a pretty exciting time overall, okay? And I will say the one last thing that would be nice is if we can eventually get out of the recession talk, which we're probably not going to be able to get out of that in the short term, but whenever people feel more confident about the economy and there's not so much worry about recession, I can tell you that's going to be a great day for PayPal. Because that's one of the other last holdbacks of PayPal is like people feel like, if there's a recession, PayPal's revenues will be weak in that environment and all these sorts of things, right? And I can't debate that. Like, that's a valid point, right? Like, in big recessions, everybody's revenue is weak. Like, that's just how it is, right? So we'll see. We'll see how it all shakes out. But it's very exciting that PayPal's finally getting some respect for the first time in the longest time, okay? Appreciate everybody joining me as always. Thank you so much for being here, folks. If you're looking to become a great investor, get access to my private wealth group, my private stock group. That'll be pinned comment down there, as well as get access to 1000xstocks.com. Take your game up to the much next level. Let's get serious about this market. All right, guys, much love and have a great day.